And we know that central banks have been binging like crazy on gold. Why? Because you just listened to the whole group over at the FDIC. You think central bankers don't know that better than you and me? Oh, yes, they do. And they also have an indication of just how close we are. And while everybody makes this assumption that they want this thing to keep going forever, I do not make that assumption, because there's virtually no purchasing power left in the currency, and they're anchored somewhere near zero. They're attempting to do a liftoff in interest rates, but that's pushing us into much more than a global recession. Although, if you listen, you're going to hear, oh, this is just going to be a mild recession. No, this is the end of this currency's life cycle. It's the end. It's over. It's over. There's no purchasing power left. They have to attack principal. That is, by the way, what negative rates are. But this is not impacted by it. And who knows more about money than central bankers? And who knows more about what they're doing than central bankers? But also the 1%, right? Look at that, these coins. Now, this is not an ultra rarity. This is a lot more common than that, which is all we need. I just want to be in this category. You don't need to spend $8 million on a coin. But I want to be in this category because, as we're seeing in places like Ghana and India, etc., that gold can easily be, well, not easily, but gold can be confiscated. They don't want you to hold your wealth. But are they going to swap an $8 million coin for $42.22 or even $50, which is the face value of the new 1 ounce gold eagles? No. So I want to be in that category, so it doesn't matter. What if I'm right and they confiscate? What if I'm wrong and they don't confiscate? Doesn't matter. 100 bazillion %, this is the end of this currency's life cycle. And nobody seems to be talking about it but me. I lived through it. I lived through it in 71. I know what that looks like. I want to live through it this time with my wealth protected. Because who knows more about protecting and accumulating wealth than the 1%? I mean, seriously, do you really think that it's just a coincidence that global central banks and the 1% are accumulating gold as fast as they can at the same time? I don't think it's coincidence. And I think this is what you should do too. It's what I'm doing. In the beginning, we had gold and silver money. You didn't need any guarantees because these were the guarantees. Then they transitioned us to this is a gold certificate, a $10 gold certificate. So you'd walk in the bank with this and you could walk out like that with that. And so that helped you feel like, okay, well, these had some value until they don't. But what's coming up is about to devastate most people, and the foundation is laid. What he was really talking about is after the confiscation of the gold in 33, those are the good assets that he's referring to. And he's also referring to the revaluation when he was talking about them being able to issue this money in large volumes. So he wanted to prevent the run to continue, much as we saw back in March of 2020 when we had all these central bankers coming out and saying, you don't have to worry about your cash in the bank or your money in the bank because we can just create as much as we want to. So don't worry about it. It's the same kind of rule book that they used to use. And by the way, I'm going to show you this. This is the $10 gold certificate. And you could walk into the bank with this and walk out of the bank with this $10 gold coin. Well, I want you to take a look at the new $10 bills after that. They look very, very similar. So that's the way they make these transitions. They'll change the laws to instill that confidence, and they'll try and keep things looking as close to normal as possible so that you don't realize that anything has changed when in reality, everything had changed. The other thing that they did was install the Glass-Steagall Act, which separated deposit-taking banks from investment risk-taking banks. So they wanted everybody to feel confident because, after all, what created the crash in 29 was a lot of risk-taking. There's more to it, but that's for another day. And they guaranteed deposits. That's when the FDIC was born, so that people would put their deposit in the bank, trusting that they would be able to get it back out again. But I think it's really interesting that openly he was talking about the revaluation of gold to dollars, which enabled them to print so many more. Because after all, they're backed by good assets. Guess what, guys? These are still good assets. But, you know, this evolution, they can't do things overnight because then you notice things and you make different choices. And I've talked about this many times. In 95, they legalized Reg D, and that actually was about the banks having more money to work with in their speculations, because when you make a deposit in a bank, it is swept into a sub-account that is in the bank's name, not yours. And that's how they justify, or they legalize, the banks using your equity for their benefit. And by the way, what's that called? Deposit reclassification. It's also what sets up the bail-in. So, you know, you may think all of this is just coincidental, but I don't think any of it's coincidental. I think it was very well planned. And what happened back in 99? Financial Services Modernization Act, the Graham-Leach-Bailey Act, which repealed large parts of the Glass-Steagall Act and allowed deposit-taking banks to merge with Wall Street risk-taking banks. Okay, that was 99, and we certainly know what happened afterwards in 2008. But has that changed? No, it's just gotten bigger and bigger and bigger, all of these risks. Over time, depositor protections were removed, not a shocker. They did it again in 2008. But this also enabled consolidation of the banking sector. So back between 90 and 96, there were 37 banks down to 4 in this particular example: Citigroup, JP Morgan, Bank of America, and Wells Fargo. Those are the big 4. And you can see how we went from a whole bunch of banks down into 4. So what that really does is it concentrates the wealth and the risk inside the financial system, because if one of these 4 go down, you've heard of the term too big to fail, right? Well, this is 2007 to 2009. The crisis began in 2007. And that consolidation into fewer and fewer banks has continued. So that whole trend of consolidation of risk is happening globally as well. It is not just a U.S. issue. It is a global issue. Become your own central bank, because you cannot count on FDIC insurance. You cannot count on them. And my question is, you've got to ask yourself, is it okay if they take your deposits? Is that okay with you? Now look, we can't just close out our bank accounts, and I'm not telling you to rush and pull every penny out of the bank. If you're running a business like I am, obviously you've got to have money in there to run your business. But anything more than that, why are you leaving it at risk and in jeopardy? They have roughly a penny for every insured deposit. They have a lot of deposits that are not insured. I make sure that I have enough cash outside of the system in a private vault, so that if something like that happens, I can still pay everybody that works with me, because I don't want them to be in a bad position. Now, of course, once they take this all digital and we have CBDCs, that makes having this and this outside of the system that much more important, because it is good money, good assets, as Roosevelt says, that will get you through whatever you need to get through, because you can always convert this into the local currency if you need to, or if, like we were in the Depression, we go to bartering because people no longer trust the money, then you've got something to work with, because this has the broadest base of buyer and the broadest base of demand. And it's the only financial asset that runs no political risk and no counterparty risk.